Okay, from the low point of the day, there's a bit of a recovery on the Nifty, so that's pretty good news actually. The Nifty is now holding at around the 10,860 odd mark. In today, we'd gone down all the way to around 10,840 odd. But as promised, e-clerks, that's the stock that's sulking in trade on the back of another disappointing performance actually. We did see the third quarter, delivered a low single-digit revenue growth, and the EBIT margins, they have contracted big time. So there were a couple of one-offs as well. To discuss this and more on what's the outlook going ahead, we're joined by Mr. Prakash Gaba, the CFO of the company. Hi, Mr. Gupta. Thanks so much for joining in. Well, let's focus on the margins. I was just looking at your release. You've explained that there was, some kind of onshore delivery costs. You have commissioned a new facility or one-off costs with regard to your Pune facility. Your margins are down to around 15.3%. There were years in the past where you have done even 22, 23 and 25% as well. Going ahead, what kind of a margin number can we work with?
Hi, Nigel. Good afternoon. So you're right that margins have taken a big hit, particularly in this quarter, and even generally if you look at the last few quarters year over year. And one of the lingering reasons has been that our onshore revenue share has been increasing over last 2 to 3 years in almost 20-25% year over year growth. Whereas the offshore revenues have contracted in absolute terms. So if you go, 2-3 years back, they used to be $45 million a quarter, and now they stand at about $39 million. And that was the most profitable piece. The onshore work, because it's in investment phase, it's a little bit drag on the margin due to investments. So because of that mix change, the margin shift has been quite radical over last 2-3 years. In addition to that, I think this quarter is particularly because of, about 5 crores or so of one-off cost, which will last in Q4 also, but from Q1 they should disappear.
So they'll disappear. So, Rohitash, if you could give us a broad outlook. By quarter one of the next year, that's the next financial year, June-ended quarter, what kind of margin number should we look at? There is pain in quarter 3. Quarter 4, you're saying that could be some more pain. Then what's the margin number we work with? A 300 basis points expansion from this 15%, closer towards 20%. Is that a number we can work with?
So I think if you look at Q2 or Q1, there was obviously no impact of this particular one-off at that point of time, right? So I think that could be the base excluding the one-off. And on that, I think one has to bake in the offshore revenue growth, which is little uncertain at this point of time. So once that picks up, I think we should be up from Q2 absolute margin levels.
Okay, any number you want to put in?
No, I would refrain from putting a number. As I said, the dependency is primarily on offshore absolute revenue growth. Okay. And remember, in Q1, the wage impacts will also come in.
Sure. Okay, can you talk about the stress that you're seeing in any of your clients, and how long do you think it will linger on?
So in terms of large clients I'm defining as top 10, we don't see any particular material stress at this time. However, in a few clients which are just outside top 10, we did see some negative impact where those clients were acquired by larger companies, and which set their direction of strategic direction changed. And that is impacting us. But I think that should also be largely over by Q4, that impact.
Okay, the other point that you spoke about was how your revenue mix changed. The move from offshore to onshore is also impacting your margins. Now, currently, onshore revenue mix is about 23%. It was about 17% a couple of quarters ago. From here on, given the business environment, how much do you think this onshore revenue mix could go up from the current 23%?
In near term, we don't anticipate it to cross 25% because there has been, some green shoots of offshore revenue growth as well, where we bagged one of our larger deals offshore. So I think both revenues should grow in tandem from here on, whereby the mix of onshore should not cross the current levels, or let's say 25%.
Okay, so that will be good news for your margins as you've been explaining to us. But in terms of offshore revenues, if I got that number right, you said that you were doing around $45 million on a quarterly basis. That's down to around $39 million. Is there a downside risk to that as well? Or $39 million, you'll at least continue at that sort of a pace with some kind of growth?
If you look just last 2 to 3 quarters, we have been about that mark. So it's reasonably flattish. I don't see any further downside to that absolute number.
Okay. All right. Just one more question. Cash in the book, 720 crores. That's about 190 rupees of your share price. What plans with respect to utilization? Would you look to utilize it a little different, up your dividend payout ratio?
So if you look at last 3 years, we have been distributing about 55% of our net operating cash flow as well as, the operating margin. And we think that we will maintain that using a mix of the two instruments that we have used in the past, which are dividends and buybacks.
Okay, all right. Thanks so much, Rohitash, for stopping by and giving us all those details. All the best for the fourth quarter, as well as looking at your margins from Q1 of next fiscal year. Well, we'll slip into a short break. You come back, we'll tell you how to trade on the Nifty. Ashwini Gujral and Prakash Gaba will be with us.
Welcome back. Keep your eye on Vedanta. That was supposed to have held a conference call to clarify on the corporate governance issues and concerns surrounding their cash utilization policy. But that conference call, we understand, has been cancelled. So the questions still remain, and the stock is down 1.5%. But in the meanwhile, let's focus on Diwan Housing. That's a stock which has gained close to about 7% Rating agencies have downgraded Diwan Housing a day after the company sold its Aadhar housing for 2,700 crore rupees. In a conference call which was held earlier today, the management said that a strategic partner should be on board in the next 90 days. Listen in.
It is alleged that the loans have been sanctioned and disbursed to non-existent slum rehabilitation projects. This statement is completely false. The complaint is riddled with false allegations and false statements. It alleges setting up and using of shell companies. It is, however, relevant to note that not a single one of these companies was designated or described as a shell company by the Ministry of Corporate Affairs, Government of India, when it issued its list of shell companies in the year 2017. The complaint also suggests concocted loans given to various entities which are perpetually outstanding. In fact, many of those loans of an aggregate value of rupees 2,250 crores have already been repaid. We were surprised and shocked that the rating agencies have announced a re-rating of DHFL's debt in view of recent events. The re-rating is not a reflection of any deterioration in our asset credit quality or on our liquidity. It is more in response to the decline in the share price and the rise in the bond yields, which is what is observed by the rating agency in their rationale. We have not received any queries from MCA yet, but these are not shell companies. These are entities where active lending has already happened. So yes, I hear that there are specific questions related to MCA, etc., which we would like to counter and say that none of these entities, that the monies have gone to our shell companies. Whether to split the loan between retail and non-retail, anything which is in the larger interest of my stakeholders will be done, even if it means for us to split the book going forward. Now, this is normally time-bound process. It may take 3 to 5 months, right? But the strategic intent is very clear that everything will be done to make sure that the stakeholders' interest is kept in mind foremost, than anything else.
Okay, all right. Market's seen a bit of a recovery from the lows. How do you trade the Nifty from here? Ashwini Gujral and Prakash Gaba, both of them are with us. Good day, gentlemen. Thanks so much for joining in. Ashwini, coming across to you first. What's the trade on the Nifty? We've seen a bit of a bounce from the lows. Do you think today's low will get protected, or do you believe that we're in for a bit of a down day?
What I am seeing is that now the pharma space is also getting hammered. So, this is a decline which is spreading. So, whatever rally you got is a good time to get short on Nifty as well as Bank Nifty. I think the market lacks momentum on the upside, and you will not have, serious rallies which will be able to scare the bears. Having said that, Shrey Infra is a sell with a stop of 27, target of 20. Oro Pharma is a sell with a stop of 790, target of 765. And IGL is a buy with a stop of 290, target of 305.
Anything in the metal space, Ashwini, to go short?
All these corporate governance issues with Vedanta, Tata Steel, etc. Basically, if the sentiment gets bad on these, highly indebted companies, everything where there's big debt will get impacted. Metals also is coming off fairly strongly, sharply. The only saving grace is that, small consumption, which is kind of holding up. Rest everything seems to be coming off fairly sharply.
Ashwini, just for the benefit of our viewers, if you're shorting the index at these levels, where does your stop loss come in at?
Basically, 950, 960, that has been a high for recent times. That's a fairly decent stop. And, we are in a range, which means 10,600, 11,000 band. If we don't take out one end of the band, chances are we'll go towards the other end of the band. So to buy here thinking, you've fallen a lot could be fairly early, because, either the markets are building on shorts or they are covering their shorts. So at 10,600, people tend to cover shorts and you get those sharp moves. I don't think right now there are enough shorts in the system to provide support at lower levels. In fact, people are probably slowly cutting their long positions, and that is what is taking the market lower.
As we speak, we're perched at the 200-day moving average in the Nifty, which is a level of 10,845. Prakash Gaba is also here with us in the studio. Prakash, afternoon. Your trade on the index, are you sensing we're going to break down and move towards the lower end of the trading range? And your picks?
Good afternoon, Rima. What I'm looking at is today should not be seen in isolation. Today should not be seen even compared to Friday. It's a Thursday, Friday, and today when you look at it, tells you we have run up too much, too fast. Needs to correct, needs a breather, some kind of a pause. What we are seeing today is a pause. So far, as long as 10,800 holds, the trend is still intact up. Perhaps before the credit policy, we could see until then at least some kind of a sideways action. And if the credit policy is good, a breakout, because the market still is up and it's not been compromised. The trend is still intact up. So I would wait for a pause or a breather. I have one long, one short. Hero Motors certainly looks good to me. Seen a good up move on Friday. Today is again a pause. Looks like up move could continue in Hero Motors. Target on the upside is in the vicinity of 3,000 zones or even higher. The first target would be 3,000. Stop below 2,700 should be okay. Stocks that look weak, I think is Bharti, Airtel. Is the Reliance communication effect coming on Bharti? Looks weak. Basic structure weak. Sideways consolidation. It's not a consolidation. It looks like more of a sideways move coming in. Stop about today's high somewhere closer to 312 and a possibility of 290. So Bharti looks weak.
Okay, all right. Thanks so much, gentlemen, for joining in. The disclosures as well will flash for you on the screen. Well, let's move on then. India Bulls Consumer Finance, that's a wholly owned subsidiary of India Bulls Ventures. That's on our radar on the back of some fundraising plans. And they plan to raise roughly around 250 crore rupees via secured non-convertible debentures. To discuss this and more, we're joined by Mr. Pinang Shah, the CEO of the company, who joins us in the studio. Hi, Pinang. Thanks so much for coming down to the studio
Hi,
today.
good afternoon. Thank you.
Give us a few details. 250 crores. We have the quantum. At what rate? If you could give us a rough, number out there, and the duration as well. If you could fill us in with those details. I believe it's open today, right? What's been the response?
That's right. So the base issue size for this public issue of NCDs is 250 crores, and the company's filed a shelf prospectus to raise up to 3,000 crores. Right. The issue is available across 3 tenor buckets: 26 months, 38 months, and 60 months. Interest rates ranging from 10.75 to 11%. Considering this is an inaugural issue for the company, we are offering attractive interest rates for investors to choose from.
Okay, but this is much higher than your cost of funds. Your cost of funds as of the December quarter was at 9.75%. Now you're offering more than 100 basis points higher. How will it alter your overall, your funding mix as well as the spreads that you're likely to report in the coming quarter?
Sure. So largely, you will not see any impact on business in terms of spreads for us.
Even if you do the entire 3,000 crores.
That's right. Okay. That's more driven by the fact that the company has a very high equity capital. So our capital adequacy is running at little above 37%, and there is enough and more cushion which we have in terms of our spreads which we should be able to maintain.
And if you could give us some clarity on your borrowing mix?
So presently, as of 31st of December, 75% of our borrowings are in the nature of term loans, 22% through capital market borrowings, and 3% is through portfolio sell down or securitization.
Okay. If you could just tell us, you've said 75% of the net proceeds of the issue will be for lending and for repayment of your interest. So since you could raise either 250 crore or even go up to 3,000 crore, walk us through how much of the money that you actually need for repaying your existing interest costs as well as principal repayment and even for lending.
So actually, if you see, the large part of these proceeds are actually going to be utilized for funding future growth of the company. So if you see our asset liability position, we are pretty well matched in terms of having enough and more liquidity on books to ensure our repayments are taken care of. So all of this is effectively going for funding growth, which we anticipate to come in the business.
And what is the number on growth that you anticipate?
So December, we closed with an assets under management of 10,450 crores. We expect this number to be close to 12,000 crores end of March 2019.
All right. Okay. If you could give us a few more details in terms of your loan mix as well as your geographic breakup as well, and how do you see that changing going ahead?
Sure. So, 33% of our loan assets are personal loans. 18% are unsecured SME loans, and the balance 49% are secured loans. So in terms of our geographical presence, we are present in 124 cities across India and evenly distributed across the entire geography of the nation.
Okay. What is your current asset quality right now?
In terms of our gross NPLs, we have a 0.32% of gross non-performing assets, and net non-performing assets are at 0.08%.
And any stress that you're sensing for your own business on account of the current liquidity crunch?
So not really. I think the asset quality which we are observing is largely in line with our business strategy, and that's what gives us confidence to pursue growth in this market. So in that construct, we are pretty comfortable. Liquidity crunch per se is not really impacting the ability of our consumers to pay back loans.
And any slowdown in demand from consumers? Because you're seeing that in the auto numbers, for instance, a tepid consumer sentiment.
Some stress on business?
Not really. Actually, it's the other way around, to be honest. If you look at the personal loan industry in India, through the course of last 3 years, it's been compounding, growing at a rate of about 27% CAGR. So in that context, we don't really see an impact in demand. If at all, if you were to look at the measures taken during the budget, the increase in disposable income for the middle class who's earning up to 5 lakh rupees,
even in the last 2 months, you've not seen consumer demand slowing down?
So there is enough and more demand for one to grow business. Actually, that's really not something which is impeding. It's more driven by the fact that how is it that one wants to rationalize growth and pursue in terms of business strategies.
Okay. All right. Thanks so much, Mr. Shah, for coming down and giving us all those details. All the best, and good to hear you're sounding quite upbeat. We have been hearing that there is a bit of a slowdown, but not according to you. So that's pretty good.
Thank you very much.
Well. Thanks so much for joining in. Well, on that note, I think we'll slip into a short break. You come back, and we'll get chatting with another management. The management of JMC Projects will be with us. Welcome back to Halftime Report here on CNBC TV 18. Now, JMC Projects, that's the next talk on our radar. Remember, they posted a rather good set of numbers in the third quarter. It was driven by traffic growth, while the revenue was boosted by a pickup in execution in the infrastructure business. To discuss this and more, we're joined by Mr. Manoj Tulsian, the whole-time director and CFO of the company. Hi, Mr. Tulsian. Thanks so much, sir, for joining in. Well, 26% growth on the top line. That's looking good. If you could tell us the segmental breakup, how much of your revenues is coming in from the infra space, how much of it is from buildings, and break it up in terms of growth as well. What's really boosting this 26% growth that we have seen?
Good afternoon, Nigel. Thank you very much for your compliments.
Afternoon.
See, the growth for the 9 months has come from infra segment because most of the orders which got built up in the last 15 months has been on infra, right? And you know that the real estate sector per se has been under pressure, for now almost for 3 to 4 years. So for the first 9 months, we have seen a growth of around 30% on the infra side and around 8 to 9% on the factories and buildings. And we continue to see this growth happening on the infra book, both in terms of top line and bottom line.
Okay. Mr. Tulsian, the other heartening feature of your numbers this time has been the strong order inflows. For the first 9 months of this year, your order inflows have been in excess of 5,000 crore. And I remember the last time we had spoken, post your numbers, you had said for the full year, you'd expected order inflows to be, close to 5,000 crores, and you've achieved it in 9 months itself. Your L1 stands at 700 crores. Have we seen a seminal pickup in order inflows? Is that an account to do with we're close to the election season? And what can you guide in the coming year?
Rima, so all your numbers are correct, what you have been talking. And we, as you know, that, we are very conservative in terms of, managing this business and have been very conscious also in taking new orders. The most important thing has been that we have to continue to, maintain our margin profile or continue to focus on improvement of margin profile. That's how with the quality order book, we have been able to move our margin from as low as 4.5% around 5 years back to almost now more than 10%. So our first principle, whenever now we go for any bidding is to make sure that, the margin should not get hurt. Now, given that situation, it is clearly a case of, our strike ratio. So fortunately this year we were able to strike a couple of projects, large projects, because of which the order intakes have improved, right? And we revised our guidance also now for the full year to around 6,000 crores or maybe slightly more than that. Now, having said that, I think that is a very good sign for us, looking at elections in the next 4 or 5 months, right, where there might be some chances of orders drying out, giving us a very good visibility for next, 2 to 2.5 years to deliver growth from here also.
Okay, all right. You're sounding quite, positive going ahead, Mr. Tulsian. But if you could tell us, has there been any slowdown? You mentioned it's an election year as well. Do you expect to see some sort of a slowdown? Is that already baked in terms of what you're working with going ahead?
Well, surely for us, I think, it is good time only because, our order book now has crossed around 10,000 crores. Which gives us very good visibility for growth even for next year and the subsequent year. But having said that, I would not say that, because of election time, the orders will dry out. We are still seeing a lot of bids coming in continuously in the sectors where we are bidding, right? And depending on our success rate, we may build up, we may not build up. I'm saying even in the worst situation, if we are not able to build up, I have a very good visibility of growth for the next 18 to 24 months.
Okay, so 14% revenue growth in the first 9 months of the year. Are you likely to end the year with a 14-15% kind of growth? And even in FY20, if on account of elections we see the order inflows dry up, you will still be able to maintain this 15% run rate purely by executing the current orders on hand?
Surely, because last year we grew at 18%. This year our initial guidance was 15 to 20%. We have done around 14% 9 months, and I'm very sure that, by the year end, we should be somewhere between 18 to 20% for this year.
Oh.
Having said that, even for next year, with the type of order book what we have, we are well on target to deliver anything between 15 and 20. Once we do our budgeting, I think, the more realistic number would be around 20%.
Okay, all right. So we are bracing ourselves, I think, for a bumper Q4 as well, just going by the numbers that you're telling us, Mr. Tulsian. But quickly, before we let you go, you had an ongoing, arbitration with Engineers India. Give us some clarity on that. What is the amount related out there? And what's the timelines as well? All our viewers, your investors can work with?
Being in the business where we do a lot of government projects, we continue to have, a lot of claims. Right, this is an arbitration case which we won around 3 months back. And then the department has gone against us, which is a very normal process in these cases, right? The good part is we as a company also don't book any part of this arbitration awards into our profit and loss account. So we have a good kitty of such arbitration awards which has already been given in our favor, but which we have yet to cross the hurdle of, winning the same at High Court level. Once that happens, then that will be like an additional bonus which comes and adds up to the P&L account. Coming back to the EIL matter, once it gets decided at the High Court, which takes its own time, then only we will bring it to the P&L. But normally speaking, we have seen that, once a case is won at the arbitration level, more than 95% chances that we will win it at High Court level also.
Okay, fingers crossed for that from your shareholders. Thanks, Mr. Tulsian, for joining in. So that's GMC Projects for you. Get into a break on that note. On the other side, we'll get you more on the markets and individual stocks. Stay tuned. Welcome back. At the low point of the day again for our markets at 10,840 on the Nifty. The mid-caps have accelerated their falls, so down more than 200 points, a cut of 1.25%. And again, this is in the face of positive Asian markets, where the Chinese markets are up 1.3%, and in the others, like the Japanese markets, Hang Seng, are showing you some green on the screen. So the problem seems to be very internal. Let's get you some market opinion now. We've got Neelkant Mishra of Credit Suisse and Sameer Arora of Helios Capital. Listen in to what they have to say.
I think there is uncertainty and stress on domestic growth aspects. So as prospects, the economy has slowed in the last 3-4 months, I think the pace of sell-off has accelerated. I think the uncertainty around elections also is something that affects the small and mid caps a lot more than the large caps, because that's where a lot of the domestic shareholding is. Are now hearing that other large groups which have heavy levels of indebtedness, some of which were known, some of which not really well known, are now coming into the crosshairs. And this is absolutely nothing to say that those groups are insolvent. But yes, I think the market is becoming very jittery about providing liquidity to them, and which is something that I think is also driving the economic slowdown.
I'm feeling okay about the market, but not good. First of all, Indian market is really underperforming Asia and emerging markets, which itself is a bit of a drag. It is actually, in real terms, already a bear market or whatever you want to call it, because other than these 3-4 stocks, which is Reliance, TCS, Infosys, and maybe 1 or 2 more, basically the rest of the market is down at least 3 to 4% more than what the index shows. I think the most important thing is what happens in NCLT today, because we cannot have this situation where step-down subsidiaries cannot have their own financing and everything is driven by what the parent is doing. Because imagine how any infrastructure project would be financed if you can't ring-fence all those flows and cash flows and say, no, it all goes into a big blind pool. Our problem is that these such significant issues, not just for the stock market, but for the debt market, infrastructure market.
Welcome back. Take a look at the metal prices now, which are trading quite mixed, but more gains really, especially on LME. Remember, the Shanghai markets are shut as China heads in for the Lunar New Year holidays starting today for the rest of this week. So there are 2 ways to look at it. One, of course, is that you are looking at stronger US non-farm payroll data. That means that the demand in the Western world is expected to be higher. And on the other side, it also is about the US and China trade talks that seem to be closer to resolve. The US president has said that he is looking at a comprehensive resolve to the trade concerns in coming weeks, intends also meeting the China premier, and that is exactly where the metals are taking support from on your screens right now. To talk about that and more, we are now joined by T. Gnansekar of Comtrends. Gnansekar, hi. What is your sense on the metal space? Is it a pure sentiment play that we are seeing in prices, or would you start looking at demand and supply picture more closely?
I think it's a sentiment play, Manisha. We clearly know that there have been supply issues in metals, but market disregarded that simply because there was this problem with the negotiations between US and China. So I think the same factor could come into support prices, and it will sort of put a floor. So I don't see any major corrections happening from here, even though there's a possibility dollar could strengthen a little bit here and there. But overall, there are a lot of positive factors riding metals, and I still believe that 2019 could be a very strong year for metals, because they've languished for a very long time, and there is going to be supply issues coming forward. So, it's a clear buy and dips both for the short term, medium term, and the long term.
Any particular metals that you are favoring with that kind of a background?
I think I would look at the growth-based metals like copper, nickel, aluminium to some extent, and lead, because all 3 of them are associated with the EV market. So potentially these metals could really come in for a strong rally.
Sure. What's your sense on the crude oil prices? Because we've closed January very positive. We've started Feb on a higher note as well. More gains on your radar?
Yeah, I think on a technical basis, we're clearly seeing another $10 kind of a move. If I look at the substantiating factors and fundamentals, I think there are a lot of positives that are riding the crude oil prices currently. The OPEC supply cuts and the Venezuelan problems. And in various other factors, the job growth numbers are quite good. So all these are positive factors, and I think it could break out soon, and Brent could touch somewhere close to 72, and NYMEX in the range of 65 thereabouts. So I'm seeing a bullish market going ahead for crude, clearly, both fundamentally and technically. And
very quickly, are you bullish on the precious metal space as well?
Yeah, absolutely. I think precious metals, irrespective of what happens to the dollar, overall, I think it's still slated to do well, simply because the risk aversion continues, and overall the market tends to be well supported around 1300 or thereabouts. So precious metals extremely good, crude extremely good, base metals also extremely good.
Okay, all right. Thanks so much for that. Well, the market's at the low point of the day, but we'll wrap up on the show. You stay with us. Business Lunch comes up next.